We're joined by Giles Keating. Giles is Global Head of Research at Credit Suisse. Giles, Greece, it's pretty much a test case here for Europe as a whole, isn't it?
I think it is, yes. Of course, there's concern over some other countries, although Greece definitely has the worst deficit and debt metrics of any of them. If the Greek crisis can be successfully contained, then I think that is a good lesson for Europe in future.
Now, Romano Prodi has been talking as well, and he says, well, it's over. The Greek crisis is over. Just because he says it doesn't mean that it's true.
Well, I think the worst of it is over. Of course, there's a very long, hard road ahead, and there'll be very difficult moments for the markets and for the Greek people. But I think the worst is past. Greece has, after all, introduced really quite tight measures to help bring down the deficit. And while we don't know exactly how successful they'll be, they clearly go in the right direction.
When we look at this, and you use the word containment, and has it been contained? Is there any chance of so-called contagion here to some of these other countries there? And of course, the likes of Spain and Portugal come up.
I think it's remarkable if we look back at the price action throughout the Greek crisis. While the Greek CDS spreads absolutely soared, those in Ireland were rock solid. The market didn't move at all because, after all, Ireland has already introduced its own very tough measures. And even Spain, although the CDS nudged out, it was a relatively very marginal move. So far, contagion hasn't happened. And, of course, it could in future, but the fact that it didn't during the worst of that crisis makes me rather doubtful.
Perhaps everybody was concentrating on Greece.
Well, perhaps they were, but perhaps it's just the case that Greece is substantially worse. Its deficit is very much higher than any of the others. Its debt to GDP ratio is much higher than anyone else except Italy. And, of course, Italy has already gone some way to putting its own house in order a couple of years ago by reducing its own deficit substantially.
Now, who is the most vulnerable, though, after Greece?
Well, if I look around, you mean within the Eurozone? Yes. If I look within the Eurozone...
You can have a look at Europe, and we can include Britain in that.
Yeah, then I think that's a better example. I think Britain clearly is a vulnerable country, and we've already seen some weakness in sterling. Now, as it were, I think investors are waiting to see what the political signals are. But I think if in the run-up to the election, it becomes clear that there is no appetite for credible measures to reduce the deficit in a credible time frame, then you can clearly have a renewed round of pressure on sterling.
Let's just get to the heart of the Euro project, though. We've got the likes of Germany and France, which are strong economies, and we've got the southern nations as well, which are much weaker. How can you redress the imbalances? What needs to be done?
Well, I think there are cyclical measures and there are structural ones. Cyclically, it's a simple formula, which is that the southern countries that have the big deficits have to tighten, and Germany and France have to ease fiscal policy. And that, by the way, is exactly what's happening. Germany has an enormous fiscal expansion this year. France, a smaller but worthwhile one. So that's actually on track. And overall, Eurozone fiscal policy is expansionary this year. Longer term, it's deeper structural problems, and that means wages, competitiveness, and that's a really big issue in Spain and Italy.
Yes or no, can you have monetary union without fiscal union in the long term?
Oh, yes, yes. I mean, in the United States, after all, the states do some pretty strange things fiscally.
Thank you very much indeed for joining us there. That's Giles Keating from Credit Suisse.